Speculation is not a game of excitement. It is not a casino of flashing numbers and loud opinions. It is a silent battlefield where discipline decides survival. Before the opening bell rings, before headlines begin to influence fragile minds, the real battle has already started inside the trader. Fear whispers. Greed argues. Ego demands action. And the market waits patiently for weakness. Jesse Livermore understood something most people never will. The market is not a puzzle to be solved. It is human nature on display. Every tick represents hope. Every drop reflects panic. Every rally carries disbelief before it carries confidence. Price does not move randomly. It moves because people move. And people are predictable in one way: they are ruled by emotion. The amateur believes he must always be in the market. He equates activity with productivity. He feels intelligent when he predicts a move before it happens. But prediction is ego disguised as skill. Livermore learned early that anticipation is expensive. The market does not reward those who guess. It rewards those who wait. He once said, "The big money is not in the buying or the selling. It is in the waiting." That statement is not poetic. It is surgical. Most losses are not caused by lack of intelligence. They are caused by lack of patience. The need to act. The fear of missing out. The discomfort of sitting still while price forms structure. Speculation demands emotional control before analytical skill. Charts can be studied. Indicators can be memorized. Strategies can be copied. But self-control cannot be borrowed. It must be built, and it is built through pain. Small losses teach humility. Large losses teach destruction. The wise speculator chooses humility. The first golden rule is simple but brutal. Trade with the trend. Do not fight momentum. Do not argue with price. When the market confirms direction, align with it. When it is uncertain, step aside. The tape reflects collective conviction. Your opinion reflects personal bias. The tape is stronger. The second rule is even harsher. Cut losses without hesitation. The market does not care about your entry price. It does not respect your confidence. When a trade violates its logic, exit. Small losses are the cost of doing business. Large losses are the result of denial. And denial is expensive. Livermore never allowed hope to override evidence. Hope is not a strategy. It is a trap. When traders hold losing positions, they are not managing capital. They are protecting ego. They are refusing to admit error. But the market punishes emotional attachment. It rewards flexibility. The third rule defines the difference between average and extraordinary results. Let profits run. Most traders close winning trades too early. They fear giving back gains. They seek quick validation. But real wealth is built through sustained trends. When the market proves you right, give it room. Strength compounds. Momentum accelerates. Patience multiplies. Speculation is not about being right often. It is about being right big. A few powerful trends can outweigh dozens of small losses. But this requires emotional resilience. You must endure pullbacks without panic. You must sit through noise without reacting. You must trust structure over sensation. Another principle Livermore lived by was never averaging down. Adding to a losing position is an argument with reality. The market is not wrong. Timing may be wrong. Analysis may be incomplete. But adding more capital to a mistake magnifies weakness. Increase exposure only when the market confirms your judgment, not when it challenges it. The disciplined speculator studies price behavior relentlessly. Not headlines. Not rumors. Not predictions. Price and volume reveal truth. Accumulation leaves footprints. Distribution leaves clues. Markets whisper before they scream. Those who listen early position themselves before the crowd reacts. Speculation is psychological warfare. The crowd buys comfort and sells fear. The professional buys fear and sells comfort. When panic reaches extremes, opportunity forms. When optimism becomes universal, danger grows. Emotional extremes create financial asymmetry. Livermore's life was filled with both extraordinary gains and devastating losses, but his principles survived because they are rooted in human behavior. Markets evolve. Technology changes. Instruments transform. Human emotion does not. Fear and greed remain constant. The market will tempt you daily. It will seduce you with movement. It will provoke you with volatility. It will challenge your patience and test your conviction. But speculation is not about reacting to every movement. It is about responding only when probability aligns with discipline. In this arena, survival is victory, growth is earned, and mastery begins with one realization. You are not competing against the market. You are competing against your own impulses. Control them, and you control your destiny. Lose control, and the market will take everything without emotion, without hesitation, and without apology. Speculation punishes those who seek certainty. The market never grants it. It offers probability, nothing more. And probability favors the disciplined. After mastering the foundation trend alignment, cutting losses, letting profits run, the speculator must confront a deeper battlefield, psychological endurance. Because knowing the rules is simple, following them under pressure is rare. There comes a moment in every trend when doubt intensifies. Price pulls back. News contradicts the move. Analysts debate endlessly. The crowd hesitates. This is where weak hands surrender. They exit strong positions prematurely. They abandon structure for emotion. But Livermore understood that markets breathe. Trends advance, retrace, consolidate, and then continue. Movement is not linear. It is rhythmic. The fourth golden rule emerges here with clarity. Wait for confirmation before committing significant capital. Livermore never plunged aggressively into a position based on theory alone. He waited for pivotal points, moments where price broke through resistance or collapsed beneath support with authority. Those moments signaled institutional conviction. They revealed that large interests had chosen direction. Confirmation reduces emotional noise. It replaces assumption with evidence. It transforms speculation from guessing into positioning. But confirmation requires patience, and patience feels uncomfortable. The amateur fears missing the move. The professional fears entering without proof. One acts quickly to relieve anxiety, the other waits calmly to increase probability. The fifth rule is capital preservation above all else. Without capital, there is no speculation. Without emotional stability, there is no clarity. Risk must always be measured. Exposure must be calculated. If a position is large enough to disturb your sleep, it is too large. Anxiety distorts perception, and distorted perception leads to impulsive decisions. Livermore knew that survival precedes dominance. Many traders aim for quick fortune. They leverage aggressively. They chase volatility. They equate risk with bravery. But speculation is not about courage. It is about calculation. Real strength is shown in restraint. Then comes the sixth rule. Increase size only when the market proves you correct. Livermore pyramided into winning trades. He did not add randomly. He added strategically, after the trend resumed, after consolidation resolved, after price confirmed continuation. This method compounds strength while minimizing exposure to error. Adding to strength builds momentum, adding to weakness compounds mistakes. The difference is subtle in execution, but massive in outcome. The seventh golden rule is perhaps the most profound. Understand mass psychology. Markets are not driven by logic alone. They are driven by perception. Euphoria blinds judgment. Panic erases reason. Extremes create opportunity. When optimism becomes universal, risk becomes invisible. When fear becomes overwhelming, value becomes hidden. The disciplined speculator recognizes emotional extremes as signals. He does not follow the crowd. He observes it. He measures it. And when the imbalance reaches its peak, he positions accordingly. Livermore studied behavior more than headlines. He watched how price reacted to news, not the news itself. Because news is interpretation, price is fact. When bad news fails to push a market lower, strength is forming. When good news fails to push it higher, weakness is emerging. This observation requires detachment. The speculator cannot be emotionally invested in narrative. He must be loyal only to evidence. But evidence alone is not enough. Execution must be decisive. Hesitation destroys opportunity. Once confirmation appears, action must follow without internal debate. Doubt at the point of execution reveals lack of preparation. Preparation eliminates hesitation. Rules eliminate confusion. Structure eliminates impulse. Speculation demands clarity of process. Identify the broader trend. Wait for a consolidation or pivotal breakout. Enter with defined risk. Cut losses quickly if invalidated. Add only when confirmed. Hold through normal reach. Exit when structure breaks. Simple in theory. Difficult in practice because during drawdowns, fear intensifies. During rapid gains, greed whispers to increase size recklessly. During stagnation, boredom tempts unnecessary trades. Emotional pressure is constant. Discipline must be stronger. Livermore's greatest trades were not impulsive reactions. They were strategic commitments. He waited months for the right environment, and when it arrived, he acted with conviction. That conviction was not emotional, it was structured. Speculation rewards alignment between trend, timing, psychology, and risk management. When those elements converge, probability expands. When they conflict, capital erodes. Most traders search for secret indicators, complex systems, hidden formulas, but Livermore's strategy was brutally simple. Follow strength, exit weakness, preserve capital, and let time magnify correct decisions. Time is the silent multiplier. When positioned correctly, it works in your favor. When positioned incorrectly, it accelerates loss. The market offers endless opportunities, but it offers very few high-probability moments. The disciplined speculator learns to distinguish between movement and meaning. Movement is constant. Meaning is rare. And only those who wait for meaning endure. In the end, speculation is not about intelligence. It is about emotional governance. It is about the ability to remain calm while others panic, patient while others rush, decisive while others hesitate. Master that, and the market becomes less of a threat and more of a field of calculated opportunity. The rules are simple. Living them is rare. There is a final truth about speculation that separates survival from greatness. It is not strategy alone. It is identity. The market does not simply test your analysis. It tests who you are when pressure intensifies. Every major move in history began with uncertainty. Before a powerful bull market, there was disbelief. Before catastrophic collapse, there was confidence. The turning points were invisible to the majority because the majority looks for comfort, not evidence. They wait for headlines to validate what price has already revealed. Livermore understood that markets move in phases. Accumulation, markup, distribution, collapse. These phases are not announced. They are constructed quietly. Large interests build positions when the public is distracted. They distribute when the public is convinced. The crowd enters at the end. The professional enters near the beginning. To recognize these phases, the speculator must detach from noise. Opinions multiply during volatility. Predictions dominate social conversations. But prediction is fragile. Structure is durable. Livermore did not predict tops and bottoms recklessly. He observed behavior. When rallies became weaker, despite good news, distribution was occurring. When declines failed, despite bad news, accumulation was forming. The market whispers before it screams. Most traders hear the scream and call it opportunity. The disciplined speculator hears the whisper and calls it preparation. Preparation defines execution. Execution defines outcome. There is a moment in every large trend when conviction feels uncomfortable. When you are positioned correctly but surrounded by doubt. When price pauses and uncertainty spreads. This is the emotional trial. Weak hands, exit. Strong hands evaluate structure. If the trend remains intact, they sit. If it breaks, they exit without regret, no attachment, no revenge, no ego. Speculation is not personal. The market is not against you. It is indifferent. And indifference is what makes it ruthless. It will reward discipline without emotion. It will punish arrogance without warning. Livermore experienced both extremes: immense fortune and devastating loss. His failures were not caused by lack of knowledge. They were caused by deviation from his own principles. Overconfidence, excessive leverage, emotional involvement. Even the most skilled speculator becomes vulnerable when discipline weakens. This is the enduring lesson. Rules are not guidelines. They are protection. When broken, consequences compound rapidly. The modern market moves faster. Technology has accelerated execution. Information spreads instantly. Volatility can expand within minutes. But human behavior has not evolved. Fear still accelerates selling. Greed still accelerates buying. Herd mentality still dominates decision-making, which means the principles remain timeless. Identify the primary trend. Confirm institutional participation through decisive price movement. Enter with calculated risk. Protect capital relentlessly. Increase exposure only when proven correct. Let profits compound through patience. Exit when structure fails. Repeat with discipline. This is not a formula for excitement. It is a framework for longevity. Longevity is underestimated. Many traders focus on single trades, single weeks, single gains. The professional focuses on cycles, years, decades, compounded discipline. Speculation is a long campaign, not a single battle. And within this campaign, emotional neutrality is your greatest asset. When a trade succeeds, remain composed. When it fails, remain composed. Emotional spikes distort future judgment. Consistency of temperament produces consistency of performance. There will be periods of inactivity, weeks when no hyperprobability setup appears. During those times, restraint becomes strength. Cash is a position. Waiting is action. The market does not pay you for effort. It pays you for alignment. Alignment is rare, but when it appears, it must be seized with clarity. The speculator who survives is not the one who trades most. It is the one who loses least when wrong and gains most when right. Risk asymmetry defines success. Small predefined losses, large sustained gains. Over time, mathematics compounds discipline into wealth, but wealth is secondary. Mastery is primary. Because once mastery of self is achieved, external volatility loses its power. You no longer react impulsively. You respond strategically. You no longer chase movement. You wait for structure. You no longer fear correction. You evaluate evidence. In this state, the market transforms from chaos into pattern. And that is the final evolution of speculation. Not prediction, not aggression, not constant action, but controlled response. Livermore's philosophy endures because it is not dependent on error. It is dependent on psychology. Markets will continue to rise and fall. Economies will expand and contract. Innovations will disrupt industries, but human emotion will remain constant. Fear, greed, hope, regret. The disciplined speculator studies these forces not in others but in himself. Because, in the end, speculation is not about conquering the market. It is about conquering impulse. Control impulse, and you control risk. Control risk, and you control survival. Control survival, and over time, you control outcome. The arena remains unforgiving. The opportunities remain immense. The rules remain simple. Follow strength. Exit weakness. Preserve capital. Let time multiply conviction. And above all, wait with patience. Act with precision, and remain unmoved by noise. That is the strategy. That is the discipline. That is the legacy of speculation.